It's an
Okay, we are live.
Good morning, everybody.
Good morning.
morning.
Say good morning.
Good morning.
Hello, hello.
Good morning.
Good morning.
Now, a few housekeeping things, and this is for my benefit. So, Tia, are you going to see questions Q&A? Are people gonna start showing up? Tell me how this is gonna look to us as agents start plugging in.
So I'm watching on Facebook to see who is joining and if they post any questions. So you might just kind of start with some things, and as we get more questions, I'll share them with you all.
Perfect. Who is Terry 3 on the bottom there? Can they hear us?
Sorry, I had you muted. It's Terry Thompson.
Oh, hi. How are you?
Terry.
Good. How are you?
Good. I'm glad to hear your voice.
It's nice to see everybody.
Yeah, it is. Where's your little face?
Great question. Here we go. Let's see. There I am.
There you are.
Good. Hey. All right. Well, Howard and Randy, this show is all about you, and we know that you have a wealth of knowledge and information to share with our agent base, and so take it away.
Randy, you want to start this morning?
Well, yeah, we could start by talking a lot about people who are asking if they keep their mortgage in furlough, or not furlough, but deferment, or I'm going blank.
Forbearance.
Yeah, forbearance. we could start talking about that and kind of go into.
Okay.
So of the leadership people that were not on the call yesterday, does anybody have any questions about that kind of get us started? About that stimulus bill?
Howard, I watched the show yesterday that you guys did, and I was very intrigued with the response that you gave to whether or not people need or just want to use the forbearance thing. I think if you could explain that once again, that it's really not for everybody. If you can comfortably or even semi-uncomfortably make a payment, it's probably the right thing to do.
It is the right thing to do, and I think that's a great starting point. So just to kind of preface, if you didn't watch the video from yesterday, the CARES Act, the stimulus bill, has a clause in it that allows for homeowners to ask their servicer for forbearance of their mortgage. First and foremost, they can only ask for forbearance of that loan if it is being serviced by one of the kind of traditional loans, Fannie, Freddie, FHA, VA, rural development, or a 184 loan. So those loan types that are insured by kind of those quasi-government agencies, those are the only ones that are eligible. If you have an eligible loan, you can call your servicer and get approval to ask for a forbearance, anywhere from 3 to 12 months. They're only giving a 3-month in the beginning, but you can call back and ask for an additional one. And what's different about this time around, and of any time in the past, is with this forbearance, they're not asking for any type of proof. So for example, all you have to do is call your servicer and say, I have been affected by the COVID virus and I would like to take a forbearance on my loan. However, in the bill, it does not require the mortgage servicer to agree to any type of terms of how they will receive the payments back. That's the catch. There's always a catch. And I loved what Susan said in our talk yesterday is the bill has a lot of unintended consequences. And so this is one of those unintended consequences is that they say, yes, you can take a forbearance, but they do not outline how the mortgage servicer has to agree to receive those payments back. So at this point, what people are saying, and I've seen one from Wells Fargo, and the Wells Fargo one says, we've agreed to a forbearance of 3 months. At the end of the 3 months, please call us and we'll discuss if we will tack it on for 6 months, or we'll talk about if we're going to allow it for it to be tacked on to the end of your loan. And so basically, they don't know what they're going to agree to at this point. So consumers could end up with a very big mortgage payment for 3, 6, or 12 months. down the road. And so all they're doing is kicking this down the curb. And if you think about it, most families buy the house they can afford. So who can afford a double mortgage payment in 3 months or 6 months? No one. And so, you're setting yourself up for dealing with this down the road. And so if it's not something you have to have today, I do not recommend that you take a forbearance. And that's the big thing. But I want to be clear, it is designed for people who need it. And we don't want to ever come off as discouraging it. If you've lost your job and you have no means to make your mortgage payment, absolutely do it, because that's what it's set up for. It's set up for the family that needs a break, somebody who's lost their jobs. Perhaps they were in the restaurant industry and they haven't received their unemployment yet, and they need a break. But what people need to realize is that it's a break. It's a break so they can get their unemployment and then start making their payments.
I think the thing that comes up is people will ask me if they can do it just break from paying that bill. They want to catch up on their credit cards, or they want to pay some other stuff. And that's not what it's for. And so that's been kind of an interesting thing to try to convey to people, is it's not a break in just paying bills, because it will come back to get you.
Yeah.
And it can also, if I understand, affect your ability to borrow money during the course of this forbearance period. So it can affect your ability to do future business as long as you're in this process.
Absolutely, Gary. That's a great point. It will not hurt your credit long term, but while you're in the forbearance, it will show up on your credit report and it will say your loan's in forbearance. Why? Because we have to verify people make mortgage payments. And so if they're not making their mortgage payment, it will show up as that loan is in forbearance on that. Now, unlike previous forbearances or bankruptcies or foreclosures, it's not going to drag the score down, but while you're in that forbearance, nobody's going to give you another loan. So that's a really good point.
So what happens after it's all over? Does the forbearance show up on their credit?
We don't know yet. I don't know if they're going to remove it, because it's not supposed to hurt people's credit. And I was surprised it showed up, but the logic was they have to put it on there because we have to know if they're making mortgage payments or not. But so it's not supposed to hurt you, but yet it's showing up on their credit report. And if everybody knows anything about credit, getting something removed from that credit report is next to nearly impossible. So I imagine that it'll say something that it was in forbearance, and then give those times. But I will say, in our industry, we are all aware of that, and we are setting that aside. We're not going to use that against people ourselves. So the mortgage industry, if people do take a forbearance, we're not going to hold it against you down the road. And we're not going to affect what we can do, in a year from now once they get back on their feet.
We have a question from Facebook. Shelly Capel asked, I did a Streamline loan several years ago. Would that be approved?
Oh, right now? Yeah, we're still doing Streamline loans. So there's still FHA Streamlines, and there's VA IRRRLs, which is a Streamline loan, and they're still available. Absolutely. Randy started one yesterday. So that's still definitely an option. And so that kind of brings up, one of the things that our industry is facing right now is, again, and I'm going to try to keep this much simpler than I got into yesterday, is the bill created an unintended consequence in the mortgage world, because it allows for consumers to skip mortgage payments, but it does not allow for mortgage companies to skip interest payments to other people. So what that means is that this person owes the mortgage company money over here, and they get to skip making that payment. The mortgage company still has to make their payments. So what it's causing is a fear of liquidity in the mortgage industry. And it actually, unfortunately, got a little worse yesterday. And while I was on the phone yesterday, I was talking about this, and I didn't really know all of this. After I got off our call, we figured out that the mortgage industry, the mortgage-backed Fannie, Freddie, and servicers have agreed to a stopgap that after 4 payments, mortgage servicers will not have to make additional payments to those third-party people, but they have to make 4. And so now servicers are going to start looking at who's going to stop missing their payments and how much money will that be, and will I make it? And what I mean, will I make it is, will they be able to make it and not go bankrupt? And so there is a fear that some servicers out there in the market will not make it past this credit crunch, because of an unintended consequence of that stimulus bill. Meaning they passed something saying consumers can skip payments, which in effect has caused a horrible, shakeup in our industry that didn't exist. We were on solid ground. And
What is this? Give me an example of who a servicer is.
Mr. Cooper. That's a huge online servicer in America, and they're probably one of the largest. So last year, between 60 and 70% of mortgages in America were originated by non-bank mortgage lenders, like Cityscape Home Mortgage, like AMC, like Mr. Cooper, like, I can keep going. These are the people out there that are servicing mortgages that are not necessarily backed by a giant bank. Okay. And the reason is that banks back after 2008, they did not want to be they did not want their primary book of business to be lending. And so for the real estate industry to thrive, we need both. You need a non-mortgage lenders over here like Cityscape Home Mortgage, because that keeps the industry flowing. We keep money in the market. We keep options out there for people to buy houses. And that's what kept us thriving. Well, those are the people that are on the line at this point, because they're the people that are servicing those loans and they still owe money to someone else. And so it's great that that a consumer can skip their payments, but what will happen is if servicers start failing and they start pulling out of the market will begin to shrink, and it will start affecting all companies, because if you've got all of those loans funneling to a handful of people, they start tightening up too. And so your funnel, if you start funneling your book of business that's out there in the world of mortgages to smaller and smaller group of people that are buying loans, and they start tightening up their requirements, then your pool of buyers that qualify becomes smaller and smaller and smaller. And so I will say there is a challenge right now that we in our industry are asking everyone in our industry to reach out to your representatives and tell them to fix the mortgage problem. And it is a problem, because what's happening right now is that if I close a loan today and then tomorrow they choose to take a forbearance before I've even got it insured, that means that we're going to service that loan forever.
Wow.
And
we're not a servicer. So, which is,
Howard, don't you think that the other important side of that is, if we lose companies that are like us, that are non-banks, we're not the big servicers, you're going to be so limited on the kind of loans that people can do. So everyone's going to have that 700 credit score and 20% down. There go all the options for buying houses. And you as realtors don't want that. You want to be able to offer the 3.5% down and the bond money and all these other things that don't require such tight credit requirements. Don't you?
So talk about, Howard, I have not had an opportunity to watch that video that you posted yesterday. Is there a way to get that link out to?
Yeah, I'll share that video on the communication page.
So talk about that.
Yeah, and so essentially he discusses that yesterday, is that there's two mortgage insiders that talk about the fact that right now there's essentially no agreement for servicers to buy loans from mortgage banks if they go into forbearance. Yesterday, they came out with an agreement from Fannie and Freddie that they would buy them, but they would penalize the actual mortgage bank to the point of 5 to 7 points. So if I close a loan today that's $200,000, they could theoretically speaking make me pay them a check for $15,000 to take that loan off my books if that consumer calls and takes a forbearance tomorrow. And the problem is that earlier I mentioned there's no requirement to prove you need a forbearance. And so if people are not thinking about this and they just think, oh, I'm going to buy my house and close on it today, and the next month I'm going to go ahead and do a forbearance, then our industry's in trouble. And that's what's going to happen. And so they did not fix that issue. They fixed a tiny bit of it where they agreed to stop the interest payments after 4 months, but they didn't agree to purchase the loans without penalty. And that piece of the puzzle is the big problem at this point is that, so for example, a bond loan right now, if we close a bond loan and the bond loan is at, 3.5% interest, and that bond person decides to take a forbearance, and rates go up, and we have nowhere to put that loan into servicing down the road because we've been servicing it, we're theoretically stuck with that loan forever, unless we want to pay somebody to take it off our hands for this weird penalty they came up with.
Mhm.
And so that's just a simple example of again, it's an unintended consequence of allowing homeowners to skip mortgage payments without any proof of needing to do it.
There's
The
no
truth-
accountability. And here's what's interesting about you talking about if it turns out that in order for you to do this, you have to have this large purchase penalty, you or any mortgage company, mortgage bank, that's going to be passed on to the consumer. So, right? I mean, you have to pass it on somewhere.
Well, what's happening is that it's getting passed on in the credit markets. That's what's happening. And so, I'm just going to, again, I don't like to talk specifically about other mortgage companies, because the thing I will say right now is I believe wholeheartedly at this point in time, we all need to be in the industry together. We all need to be realtors and lenders, and we need to be, it's a unique period of time. And so, but everyone probably heard of one or two big banks in Tulsa that pulled pretty much out of the mortgage market. And one in particular raised their credit score requirement to 700 with a 20% down payment. And they're one of the largest banks in the world. And that was specifically because of this unintended consequence of this bill. That's what happened. And so that mortgage bank and bank just looked at their book of servicing loans and said, oh no, stop. We can't take any more people that may quit making payments. So I need to make sure that I have a guarantee that the people that take this loan out are going to make their payments regardless of what's happened in the market. And so they went out and just said, no more loans unless they have a 700 score and are putting 20% down. And so that's a unique bank that did that. But what we're seeing is that more and more banks are making changes. They're making adjustments to the credit markets. And so here's a great example too. And I, Randy was running a file yesterday, last night at like 10 o'clock. So Randy's texting me last night, pre-approving a borrower, talking to a realtor. They want to go look at a house today. And when she ran the findings, most realtors realize that we run what's called an automated underwriting system, an AUS finding on every loan to the investor, meaning Fannie or Freddie, their guidelines. So we type in all their information, we scrub it, we get it looking beautiful, and then we click a button and it runs it through a computer and pops up with a decision that says, can we do this loan or not? It's either approve eligible or it's approve ineligible, or sometimes it's refer. If refer means we can't do the loan. That means that for some reason the credit doesn't fit the box. Well, Randy was working on a loan last night and she was running it through, and it's somebody that she looked at and she said, I know this is going to work because it always works. Somebody with a 645 credit score, they had a little bit of money in the bank, they had good job history. It was pretty much a textbook. We usually get a yes. She ran it through the AUS system. It came back with a refer ineligible, and it actually said on the AUS findings, due to COVID.
Mm.
And so Fannie and Freddie and FHA are tightening up their guidelines. And they are tightening up the credit box to say, we want a stronger buyer right now.
Wow.
So temporarily, so it's going to be a hard conversation, because this is a borrower that any normal time, Randy would have issued a pre-approval last night. They would have been out shopping for a house this morning, and boom, we would have had a new case. And so it's a situation that's, So that's what you're seeing because of this unintended consequence is the credit markets are tightening, and it's not specific to one lender. So for example, that borrower, we will automate it through both LP, which is Loan Prospector, and DU, which is for Fannie Mae, and it gave us the same result. Well, that means that both Fannie and Freddie are saying no right now. Now, that doesn't mean no forever, because what's unique about today is it's temporary. And that's a really good thing, guys. So it sounds like we're all doom and gloom right now. So I want to make sure everybody thinks about this. In my opinion, this is short term. We're looking at another 60, 90 days. We're looking at getting to the summer before I think that this will lighten up in June or July. I think once the businesses start opening up, I don't know when Tulsa's going to fully open up, but let's say that the world of America starts opening up and we start functioning, fully in June. I believe the credit markets will have an idea of what is happening, and they will lighten up, and Fannie and Freddie will start lightening up. So what we are getting, which is unique, is we're getting these notifications from Fannie, Freddie, and FHA that says temporary change in guidelines, temporary change in guideline. And so it's temporary. So that's better than 2008 when it was, we're just.
Howard, I have a question. Should anybody, if they were approved already for a certain loan product, should they be checking with their lender, or are you guys reaching out to them?
Well, we are, but I think that's a great point. Randy, why don't you answer this?
Yeah, I mean, it's always helpful if somebody's still actively looking. If they haven't spoken to their lender in a while, they may want to just check in. We are trying to reach out to everybody that's pre-approved, but sometimes people go silent on us, and we can leave messages for them, and we don't always hear from them until they get excited again, and they get excited when they find a house. That's when the excitement happens. People get excited about houses, not loans. So yeah, they can check in.
It's true.
So here's another example to that is that the bond loan program. A lot of people talk about that, and a lot of people like using that loan, and we do too. We're one of the top 5 bond lenders in the state of Oklahoma. But the thing is that the bond loan program themselves tightened up their requirements, and so a realtor may think, I know this loan, and this borrower fits this loan. Well, they don't necessarily today. They're requiring a higher credit score and reserves. So again, most bond buyers don't have any money. So it's hard for them to necessarily have months of reserves and a higher credit score if they need 100% loan. So again, same story. We're telling people no, because we believe strongly that in the next 30, 60 days, that program is going to lighten up again. As we've seen, there's been moments in time in the market where the bond loan pulled out of the market due to volatility. And again, that's across every bank. When the bond loan makes a change, it's not about Cityscape Home Mortgage, it's the bond loan program. That money doesn't come from Bank of America or Bank of West or whoever, or from Cityscape Home Mortgage. It comes from the bond. So those changes that through Fannie, Freddie, FHA, the bond loan program, they are universal across all of our industry, in Oklahoma at least.
I have a question, Howard.
Yeah.
Okay, so it sounds like as agents, we need to do a lot better job of qualifying our clients right now. But if we have somebody that's interested in buying a home, and maybe they needed bond money, maybe they need a more traditional, 3.5% down FHA loan, something like that. Should we tell them to talk with you guys and wait a little bit and maybe clean up some other credit issues or save some more cash, and then in 60 days, when everything hopefully lightens up, then move forward? Or would you say still try to?
Yeah, no, that's exactly what I said to Andy last night. I was like, there's going to be a day that we qualify and they're perfect and good to go. And but there's also going to be more buyers today, and this is similar to 2008. In 2008, my business changed, and what changed is we started working with buyers to help get them approved and in a plan. Oftentimes, somebody would come to us, and we'd have to get them on a plan that was anywhere from 2 weeks to 3 months to a year. But a lot of those buyers, it's usually 30, 60 days. And so I think we're going to see more of those people today. And I think that would help if a realtor kind of prepares their buyers that today it may be something that, talk to Randy, talk to her about what you can do today. But you may need, if they're like, hey, I don't know if I've got great credit, I don't know if I have the money to buy right now. Well, they might need to be, put on a little plan and worked with us for, 2, 3, 4 weeks to get ready to buy. But in my opinion, you're selling houses today and we're teeing up those clients for June and July. We're creating a bench of clients as long as we stay connected with them. And I will tell you, they get more excited about the houses. When we get people on a credit plan, which we love to do, the realtor has to stay active and involved, because what clients are excited about, they're not excited about a mortgage. Everybody knows that. They're excited about a house. And so the person that keeps them excited about houses is the realtor. So if you send a client to us, we're going to keep up with them, but I highly recommend that the realtor involved follow up. Every 2-3 weeks, you follow up and say, hey, how's the credit plan coming? Are we going to be ready to go look at houses in, June? That's 45 days from now. If we say 45 days, then, that's keep up with them halfway through. So I think they're going to have a mix of people. I think there's going to be some people that we say, like that person last night that generally would have been approved. I think that in June, and we'll get an automated approval on them, just like we did in, January. If we had pre-approved them in January, they would have probably bought a house and went on down the road. It's just, again, HUD does not want somebody buying a house today that has a likelihood of taking the forbearance. That's really what that's about.
So is it not legal or acceptable for you as the person loaning the money to have that in paperwork up front, that you cannot do that? If we're going to loan you the money, but you can't do this.
Well, strangely enough, we actually can, because we've consulted with some, people. And so the one thing is that it's not actually serviced by Fannie and Freddie until we close it and we insure the loan with Fannie or Freddie or HUD. Mm-hmm. So when we close a loan, like let's say we close a loan today, until we actually get through the process, when it's on our books still, it's technically not a Fannie or Freddie backed loan, because we haven't actually serviced it with them. It has to be serviced by Fannie or Freddie. And so technically, if they do it before it gets to that point and they make payments to the servicer, we can actually call it due. We can foreclose on them. We're not bound to the bill. But the problem is that we're not creating the credit market. And so it doesn't do us any good as if we close, we're the number one lender in Tulsa, back and forth between one other bank. And, if we close hundreds of loans and they choose to take the forbearance and suddenly we're a giant servicer, that doesn't work for us either.
Okay, that makes sense.
So we do have some protections in there, but we'd have to sell it on. And so we'd have to write those checks. And it's an interesting thing, because it's always a debate. Why are we not a servicer? Why are we not servicing a loan? And on all of our loans? Well, here's the example why we are not. So we're really grateful. Our business is very, very, very secure. We're going to be in Tulsa forever, and this is a good thing. And I tell people, the nice thing is that if you work with us, and I've been doing this 20 years, I've had the same cell phone my entire time in this industry. And I'm much easier to get a hold of than a servicer. So people can call me and ask questions about their loans, and they still do. Mm-hmm. So to me, it's a win-win, Mm-hmm. Yeah. Other questions?
Another question with regard to business as usual. You said yesterday that you're verifying employment at the time of closing, and that is a little change from what has gone on in the past. And is that having much effect on the close rate right now?
It is. It's having a huge effect. So here's the other thing is that if we close a loan today and I call and verify employment, and then I close it, and then Fannie or FHA calls and verifies employment, and they quit their job after I close their loan, typically speaking, in the old way, it's within 10 days of closing. And we would be good if they did it afterwards. We're not good anymore. If they quit their job afterwards, we have a defaulted loan. Additionally speaking, We called to verify employment on a loan of ours a few minutes ago. That was that call I just took. And there's a recording on the company's phone that says, we are still paying employees, but we're only paying them through the end of this month.
Uh-oh.
And that's a loan that we have to close, that we're supposed to be closing. And the problem is that the person we're doing the loan for, he may be getting paid, but if a third party person calls and hears that message, we're in trouble.
Mhm.
And so that's a problem. And it's a, you know, so here's this purchase transaction that we have this is what's interesting. So Randy was kind of a leader of this. As soon as these changes came out, Randy sent a bomb to every client we had, an email to every client we had, and set the stage, because it's all about good communication. So she sent an email and said, we will need a contact with a cell phone number for your HR, because we have to verify employment the day of closing. If anything changes, this will cancel your closing. She sent it to her realtors, her buyers, everyone. We called them, we emailed them, we've let them know, we've put billboards up practically. And here we are, the day of our closing, and their job is not secure. And so, you know, our head of underwriting, Julie Griffiths, just called me and said, hey, you guys have a loan closing, and we called to verify employment. The closer called to verify employment, and it is, they just said that they're not paying employees past the end of this month. So we need to either get them to change the message and verify it. And truly, that's the route I'm going with. I'm going to call, because our guy is a big guy. Somebody on this call probably should look up me, right? I know. So I need the message changed, because the message says they're not employed. So you know, so we've got to fix that. It has to say he's employed. It has to, you know, they have to verify employment. And so the thing that's interesting, it's not necessarily completely different than it was. We're just being more careful, because Tia will tell you this. In January last year, everyone has to have a job when you get a mortgage. If you get furloughed last summer, your loan's on hold. If you get furloughed in January, your loan's on hold. But the problem is that what's different is more people are getting furloughed today than ever before. And in our industry, we all look at it as being temporary. And people want to say, well, it's just temporary. Well, we don't know. None of us can predict people's jobs or careers. If somebody's not working, they can't get a loan, period. If they're on unemployment, or they're on medical leave, or they're furloughed from their job, they cannot close on their loan, period. You know, if you are a restaurant worker and you receive tips and your restaurant's closed and they're paying you part of the salary, can we qualify you on part of the salary? Or do you need the tips? If you need the tips, we can't close your loan.
So I have a question about that. So they get furloughed and then they are brought back. Does that time period interfere with their 2 years of consecutive employment? How will that look after the fact?
That's a great question. You have a little history of this.
Maybe just a little bit.
Yeah, exactly. In this new world, and this is unique and very different, it will not. Again, that's why I keep saying this sounds all, you know, a lot of stress about this, but if and when things bounce back, we get to look at this as a blip. We get to ignore that missed job time. So for example, we have files that we've had to place on hold. We're not turning them down. It's if someone's furloughed today, we're setting them aside. We've got them all teed up to go. And as soon as they're back employed and we can verify employment, we're moving forward. And then unlike a normal time, we would have to adjust their income on that gap, even with commission. We'd have to adjust that they've had a gap or they're suddenly unsecure. Fannie, Freddie, HUD, they have all agreed that this is out of everyone's control. This has nothing to do with the buyers. This is the market. This is a virus. We get to ignore it. So that's good news, guys. So when you're negotiating a transaction, if somebody gets furloughed or their pay is temporarily put on hold, when you're communicating with the other realtor involved, tell them this is temporary and the lenders are going to ignore it. We will ignore it. Once they're back working and we feel they're securely back working, we will ignore it. But here's another example, guys. Cherokee Nations, who has been paying everybody, they asked everybody to take a voluntary furlough for 2 weeks. So if you have a manager working with Cherokee Nations, or you have an employee of the Cherokee Nation, they're in the middle of a loan that's supposed to close in the next 2 weeks, they're likely to be put on hold again because they're choosing to take that furlough, which I understand. You know, they've had all this time. Yeah.
I have a question. So what does this, and Gary and Debbie and Jessica, I'm addressing you on this as well. So what is this going to do to the sellers involved?
It's not
really good
closed until
question.
it's closed.
Yeah,
Yeah.
so can the sellers then get out of that contract and move on?
Hmm.
Or are we going to start seeing longer closing times? You know,
Yeah.
60-day closings.
Well, do you think sellers are willing to do that?
I mean, I don't think they always are going to have a choice in some regards.
Yeah, if they're in contract now, I believe that you guys can tell me this, but that COVID-19 addendum that was put out for your current contracts, that may apply.
Is everybody
If-
using that?
I'm not familiar with what that is.
Our board put out close to when this all started, a addendum to put with your listing agreements that you currently had active or that you were going to list, and then an addendum to put with your contracts that were already under contracts, obviously, or under contract. And it had to deal with if the closing on the contract side, if the closing was delayed due to COVID-19, then it was an addendum that they could, both parties could sign off on to extend, or they had some options. I'm looking at it right now.
So they can agree to that on the front end.
Right.
So if something like this were to happen, that would absolutely then tie the seller in. But
True, but
I think this is an important topic to talk about because there's a secondary problem here, right?
yes, but if you're a seller and you have a contract on your house and it's supposed to close in 30 days, and with COVID-19, they say, well, we don't want to give our buyer another 30 days. We'd like to sell to somebody else. I mean, the chances of them selling it to somebody else and actually closing in the next 30 days is highly unlikely, in my opinion. So you might as well just give that buyer a little bit more time to get through. And maybe not everybody's going to have that same opinion of me, but you know, you're going to have to resell the house if you cancel with that buyer, unless that person's truly just lost their job.
I have to tell you, we were talking about cooperation and whatnot, and I was talking to Jeff, and Jeff's in communication with a lot of other brokers in town. This communication is happening at every company, and so the realtors that we're coming in contact with when these delays happen across our whole company, across the whole state of Oklahoma, for the most part, are being understanding. We really are seeing a different attitude about this because, again, it's this horrible time. It's a virus. It's the COVID, and so thus far, knock on wood, we've not experienced anybody backing out of a contract. We've not had anybody, refuse to go ahead and take an extension. Just exactly like what you said, Max, is that, as long as there's good communication and they understand why there's been a delay and it's nothing to do with something that's not because of this situation, then I think people will usually kind of hold on until we can get to the other side of it.
Debbie, did you have something and we can't hear you? Debbie Dennis?
No, I was, what I wanted to ask Howard actually a minute ago was, if the seller does not want to go forward and we are in a situation of an employee being furloughed and on hold, they're not going to get a turn down. The buyer's not going to get a turn down letter from the lender, is he?
Well, they will. I mean, if you ask,
will?
if you ask that question, I mean, if you said to me that the deal's going to bust, so again, that's going to be a contract thing. And you're going to please forgive me because I know there's two versions of the contract on that supplemental. Are we using both of them still?
Got OREC and GTAR.
Yeah. Are they
Yeah.
still both out there? Okay. So one is protects the buyers more and one protects the sellers more. And I forget which one is which. So if they do the one the timeline, it won't really matter because this is happening sometimes up to close. And so Susan or Debbie, which of the contracts protects the buyer more? I can't remember.
I'm leaving that.
GTAR protects the seller
Yeah.
more, and OREC protects the buyer.
Okay.
Yes. Yes.
So,
Money.
so
Yes.
from if I was working with a buyer today, I would make sure I'm using the one that protects the buyer because, because what we're doing is we're finding out sometimes these furloughs today and we're closing today. Well, that's not the buyer's fault. That's but technically if they're using that GTAR one that has that timeline on there, the loan approval should have been done, 5 days or 10 days or 15 days before. Technically they could lose their earnest money. Well, not technically, they would if they fought for it, if the other side fights for it. So to me, I think that that's something that people need to be aware of today, that if there's a chance, I would hate my client or the client of the realtor to lose $1,000, $1,500 because they were furloughed today.
Well, let me put the comment in there. The clause you're talking about has a blank and it says 10 days prior to closing if left blank. And I would encourage our associates to negotiate the number of days that go in that blank. Not just A, leave it blank, or B, arbitrarily put 10 days in there.
So what would you recommend at this point, Deb?
Well, I don't know if the buyer works for the company that says we're going to pay our employees for 30 days and then we're not paying them anymore. That kind of job situation, I might put 1 day in the blank. And it's a negotiated thing up front. So let's negotiate it up front and not have a fight at the end. Is my point.
That's great. Yeah.
So
I have another question, Howard. Since we're talking about employment, we're talking about a lot of employees with companies that they work for being furloughed or laid off or whatever the issue is. What about self-employed people right now?
So Randy, why don't you answer this because that applies to the 4506 stuff. And so I think that's important.
Well, so on a lot of self-employed people, usually we just average a 2-year history of their income, and that's how we calculate income. But we always have to order IRS tax transcripts to kind of make sure that their tax returns are really calculated the way we're viewing them. And since the IRS office has been closed down, we can't get these transcripts as fast as we want. So we've been asking the clients to help us. They can just log right into the IRS and in real time, they can request their own transcripts and send them to us. And that's helped a lot with getting the self-employed borrower kind of moving along in the process faster. So we're really thankful that there's that option. I don't know what we do if we didn't have the ability to have the client help us, because it's really helped a lot.
So on W-2 buyers, the Fannie and Freddie have put out advice and they're waiving their requirement for the transcripts. So, but for a self-employed borrower, they're not. Additionally, what applies to that question would be, are they in an industry that's still functioning? So again, it's kind of like that same W-2 borrower is if I have a self-employed borrower who runs a restaurant, for example, and the restaurant's absolutely closed, we would put their loan on hold because they're not receiving income. If they're in a business that's not functioning and they're completely, the same story as a regular W-2 buyer. So we're looking at those, and it's there again. That's always a requirement. When a person applies for a mortgage, the standard for Fannie and Freddie and HUD, FHA, every of these loans we're talking about today, the standard is the assumption that a borrower will continue to be employed after we close and for the next 3 years. And I know that sounds funny to say, but that's always been the standard. It's not a standard that is just being applied today. It's a standard we've always had. Now we give grace to people that we assume they're going to be employed. But in this environment, what's different is that we're looking more closely. We're looking at their job, and we're making sure that, back in 08, we'd have loans in process, and then the newspaper would say, Williams lays off 1,000 employees. And as a lender, we'd have to go, well, were they one of those 1,000 employees that were going to get laid off? And it's the same thing. We have to look at it as if you own a pizza shop, are you functioning? And we have one right now. We have a guy who owns a pizza shop. Well, his business is primarily delivery. His world really is busier. He's making more money. And so with that self-employed borrower, we were perfectly fine. But on the flip side is that, we have two people that were the managers of a national chain restaurant at 71st and Sheridan that they were both furloughed without pay. And so they weren't. But if they owned it and they were still functioning and they were still giving, they were still selling food and they were still operating, then it would be okay. It just depends on the function of the business at this point.
So, okay, I have another question about the furlough and about sellers hanging in there with the furlough. So as the market opens back up, I think we all agree that it's going to be gradual. I think they've already sort of given some, I think the governor has given some steps as to who's going to go phase 1, who's going to be phase 2, who's going to be phase 3. I would guess that I would guess that these companies for the most part are not going to hire back 100%.
Mm-hmm.
Would you agree with that?
I would. I think that especially, and I want to be careful on how I say this. I think that the people that were put on hold, most of those people will get hired back. Unfortunately, and this is the sad truth of the people that were affected by this the most, and that's why we see these huge numbers, is that they're very low wage, customer service, hotel, restaurant. A lot of that 20 million people who have filed for unemployment, they're going to be the ones that don't get hired back right away, unfortunately, because but a lot of the people, like your Cherokee people, your dealer at a casino, your auto people, a lot of these jobs, I think, that are buying houses, I feel will be more likely to get hired back.
So, and I'm back on the seller topic. So a seller agrees to, through the COVID supplemental, to hang in. I'm just wondering about our liability but it sounds like you don't think there's a lot of liability there, that the people, if they're furloughed, they're probably going to get that job back. Because my first thought is, as a seller, if I hang in for 2 months because I don't want to have to resell my house, and this is a good person, and then they don't get rehired, and now I got to put this house back on the market, I'm not going to be very happy. Now, I don't know who I'm not going to be happy with, but everybody. Normally it falls back on the real estate company. So am I being a negative Nanny there, or is that a real concern?
No, I think that's a good question. That's the same thing we always go through. It's how far we all stick our necks out for these situations. How much are we going to, make promises for things that we can't control? And so, for example, we have one in particular situation that had like multiple goofy situations on it. And I called the listing agent and talked to her, and I shared, and that's the thing is I do what I've always done. I give sort of a blunt conversation. I overshare, and I tell all the pieces of it. Now, not everybody does that. And so that's what you're talking about is how do we know somebody's really in a good shape, Mm-hmm. And that does matter. But first and foremost, I think we all have to just use the information we have. If somebody is furloughed, that means that they're temporarily off the job. If they're laid off, and that's the language, if you're laid off, then you've been fired. You have been released from employment, and there's no guarantee that they're going to hire you back. And very likely, they're usually not. And so we had that. I had one this week, a welder who are easily employed, who was laid off. The manufacturer he worked for did a 20% layoff, and and just let people go. And they said, we don't think we'll be hiring back for 6 to 12 months. Thank you. But he got another job. So he already got another job in his field. And so they went back and said, he's been rehired. What do we need? And in his case, it's different. He falls on the old guidelines. It's just like anything else. If you quit one job and you take another job, you need 30 days worth of pay stubs. If he was furloughed, I would have accepted a letter that you're back on your job. So in his case, the time to close is even longer because he started a whole new gig. And so I need to figure out, will he stay?
So a couple of things I want to say here. It's 10:52, so we're going to start wrapping up here and getting any last questions. This has been great information, and I know I keep going back to the seller side of it. And the reason is because our agents working with buyers have to be, they really have to know all of this. They have to be closely conversing with you guys, whoever it is they're working with, and staying on top of what the status is. And if something like this happens, then they have to be very forthright and inform the listing agent. And at the same time, that listing agent cannot be pie in the sky. When they talk to the seller about what's going on, COVID supplemental and all, they can't say, oh, don't worry about it. We've got this, and they're going to get their job back in 3 weeks, and it's all going to be okay, because we don't know that. So what I love about all of this information is we have reality. And what's important in my mind is that our listing agents and our agents working with buyers deal from a place of reality. And you said it earlier in the call, Howard, and I'm going to say it again. Communication right now is everything. It is tantamount to everything. And if you can utilize Howard and Randy and having these kind of conversations, then you need to do that, because this is delicate. It's a dance, the way we're having to navigate this. So any last questions, Tia? Do we have any questions from online? Any last questions or comments from any of the players?
Royce mentioned, he said, we have been told to counter the buyer side with the GTAR supplemental. Leadership, do you have any direction on that?
Who is we? Who told them that? Where'd they get that?
That's how we train it. Sherry Lewis said we would use the GTAR form, and so that's what is being trained. We use the GTAR form, and Howard just threw that under the bus.
I know one protects one and one protects the other. So I have no opinion there.
But I like what Debbie said. Do you agree, Gary?
Well, I agree, except that's how people tried to defeat the intent of the new supplement, was by putting 0 in there, which meant it was the same as the old supplement. I think what's more important is to communicate with the seller that there may be some circumstance because of this COVID virus that this thing does not close on time, and because somebody loses their job the day before closing. Are we going to kick him when he's down further by taking his earnest money? Is that what we're all about? And again, sometimes logic and reason doesn't enter into things, but if we have the conversation that we're in extreme circumstances right now, different circumstances, and things can happen, and let's try to get the house sold as best we can, but not take advantage of a situation for your own personal, to somebody else's detriment anyway.
And again, that is communication. That is
Absolutely
the highest form of communication. And when you're having those conversations on the front end, you are helping everybody. And that's our obligation right now. This is a hard time for all of us, but it's extremely hard for buyers and sellers. And they count on us, the lenders, the real estate agents, their closers, all of the people involved to help them sail down these
Navigate.
waters.
Some
So,
wise man said that we should be the voice of reason during all of this, and sometimes that's hard to do. But
Yeah.
I think that's called upon right now, called for right now.
I agree. Okay, anybody else?
Nope, that's all I've got.
Okay, Howard and Randy, again, this was wonderful, wonderful, great information that you have shared. And I do want to ask if Jessica and Howard and Randy, do you all want to just mention Tuesday
Yeah.
happy hour?
So we're talking about doing a bingo happy hour on Tuesday. I think we're working to nail down the time, and we're gonna have some great prizes, including, and correct me on how to say the bold thing.
Bold pivot, yeah.
Bold pivot.
So Coach Michael is going to be a part of this happy hour, and one of the prizes is that he's going to pay for somebody's bold pivot.
Yeah, and we're gonna have a bunch of other prizes. Randy and I are gonna brainstorm and pull together a bunch of fun stuff today, and we will get some more information before the end of the day out to people. And I do want to end with, all of this sounds like a lot of heavy stuff, and but the thing is that I am so immensely grateful to be in Tulsa. And I know this sounds funny to say, but if you were in this industry back in 2008. You will remember that Tulsa rebounded faster than the rest of the country.
Yep.
And so our real estate world is safer, more solid and secure than most all of the other markets. And so if you stay the course, like Randy says, busy people stay busy. And we all stay focused on great communication and working through this horrible time for everybody, but we stay as positive as we can, we will come out the other end of this stronger, busier, and still have a fabulous, amazing year.
Those are great words to end with. We appreciate both of you so much. Appreciate your time. Thank you, leaders, and thank you, staff, for being on here. If I have any agents left on there, Terry, thank you for being on here, and we will talk soon.
Thank you, guys.
Thank you.